Marathon Asset Management CEO Bruce Richards. CEO Bruce Richards. Marathon has over $23 billion in assets under management, and a lot of that is private credit.
Private credit is a big, big business.
We're going to talk about those implications on private markets and public credit markets.
Here's what I think about credit. Credit markets are behaving really, really well.
This has been a very popular asset class.
A lot of that is now going into private credit.
Are there lots of cracks in corporate credit, and is that warning us of danger to come?
Credit markets are incredibly stable. Making a double-digit return on your private loans when the banks aren't lending is a beautiful thing to be doing. If you're good at making loans on good companies, then you'll make the best returns we'll see in a generation.
Good morning, everyone. Pleasure to be here, and it's a great pleasure to have Bruce Richards with us. Bruce, you are the CEO, chairman, managing partner, and co-founder of Marathon. Marathon is a leading global asset manager with $24 billion in assets, specializing in the public and private markets, credit markets. Congratulations to you and your team, Bruce, because recently you just completed a marathon with 26.2 years, navigating successfully the credit markets. It has been a pleasure to know you for a long time, and as far as I remember, we met probably around mile 7 of your marathon. So let's start with your macro view, Bruce. You have been always a prolific writer on complex macro topics. You've had a more optimistic perspective on the US economic outlook than some of your peers. What are the key drivers behind your view?
Well, Lionel, great to see you, and iConnections, great to be here with you and everyone in the audience, and thank you. And we have known each other for 20 years, and congratulations to you. I understand tomorrow you're going to become a US citizen.
Thank you.
So it's
Yes,
amazing for you, Lionel. And Lionel and I first met when Lionel was the head, the CIO of Lixor, and we met pre-GFC, and we've been friends ever since. So thank you for being here with me today, Lionel. So macro view, it's very interesting right now. Growth this quarter is going to be pretty strong because it's going to be an offset of a weak first quarter. But when you meld the two and offset kind of the tariff-induced slowdown in the first quarter and the reversal of that in the second quarter, the first half of the year, GDP should be slightly above 2%. And the PCE numbers, although we get inflation in the next couple of days, both CPI and PPI, PCE is 2.1%. So 2% GDP and 2% inflation is about as good as it gets. And if we can keep it the way it is, that would be a beautiful thing. But in the second half of this year, we're probably going to see the economy slow to about 1.5%, and inflation tick up more towards 3%, because some of the tariff-induced inflation will start to come through. But remember that tariffs are a one-time adjustment upward. Just a one-time adjustment upward. That's it. And it won't be a continued inflation adjustment upward. And so if the Fed is waiting for inflation to go up and then inflation to come back down to 2%, they're going to be waiting for a long time. And Powell will be waiting too long because the economy will be slowing. So right now in this environment, rates are a bit high. The ECB has rates at 2%. The Fed funds are 4.5%. That's where the Fed has it. And so our rates are too high relative to that level of inflation, relative to GDP. Powell was late to the party to raise rates when we had transitory at the front end of this, and he'll be late to lower rates if he waits too long and waits for inflation to come back down. That's my macro view. And the bottom line is no recession. And so that's the big picture in the next coming 12 months, the period of time that we have visibility. Consumers typically lead you into a recession because they're about 65 to 75% of GDP, consumer consumption, and they lead you out of a recession. And while there's signs of consumer weakness, we still see job strength. This last month, 139,000 jobs. In the first half of this year, around 125 to 130,000 jobs. We still see job strength and wage growth, and overall a lot of wealth among consumers, despite some lower FICO score borrowers that are a bit too stretched. And so overall, the consumer is relatively healthy, despite pockets of pain among consumers. And so we don't see the consumer leading us into recession in the coming year. And so we have a no recession call.
Bruce, you've absolutely laid the market call on the Fed moves over the last 5 years, since I've been following your calls in detail. You've also voiced concerns about growing deficits, excess government spending resulting in higher rates. Under this regime, where should LPs be investing?
So let's talk about the Fed for just a second. So the Fed raised rates between March of 22 and September of 23 by 525 basis points. Blitzkrieg, kind of Fed adjustment up. It was the fastest increase in rates that we've seen in a long time. That rate adjustment put a lot of pressure on a lot of different pockets. It put pressure on the companies that were over-levered, that are borrowing 6 times debt to EBITDA, that had too much debt relative to that, and so we saw default rates go up. It put a lot of pressure on the housing market as housing rates went up. The big deficits, on the other hand, has also been crowding out. Roughly half of all of the debt that's raised around the world, and certainly here in the US, is from the governments. And so that has a crowding out effect. When you issue as much debt as the governments are issuing, it keeps rates higher for longer and rates higher than it otherwise would be. So while the Fed has kept the front end rates high, the big deficits and this week we have 3s today, 10s tomorrow, and 22 billion of 30-year notes on Thursday. And so the big deficits are causing a lot of debt issuance and causing higher rates. And that, in fact, crowds out. It crowds out the homeowners that want to take mortgages out that have rates too high. And so there's different effects to the economy. But in this higher rate environment, the one thing that is true is that us lenders, the private credit lenders, and even the public market lenders are making exorbitant rates of return and very high rates of return relative to the risk that we're taking. And people don't understand the extent of it, but it's absolutely true. In the risk markets, let's start with the riskless market. In the riskless markets, start with cash, it earns a 4. Also, what's riskless are front-end treasuries, which earn a 4. Also, short-term investment-grade bonds that are AAA, AA, single A, relatively riskless, earns a 4. When you move to the risk markets, equities traditionally earn about a 7% rate of return. High yield and broadly syndicated loans earn around a 7.5% return historically and today. When you go to the private credit markets, fund after fund, vintage after vintage, the best credit managers are earning a 12% return for direct lending, for asset-based lending, without down quarters, with volatility that's half the volatility of the marketplace. So the volatility of private credit is a 4 to 6% volatility with a return of 12. Think about the volatility that you have in the equity markets. Historical return for equities is a 7%. Put aside 25% return in 23 and 24 for the S&P 500. Look at the first 25 years of this century, which is 2000 to 2025, the 25 years. Or look at 50 years. Or look at 75 years. Or look at 100 years. Cut the time any way you want to cut it. It's about a 7% return for equities and a 16 vol. So your vol is much higher than equities, than the equity return. But in credit, in private credit, we've been able to, the market, the upper quartile managers have been able to earn about a 12 return with a 4 to 6 vol. And so I think it's the best asset class on a risk-adjusted basis, on a volatility-adjusted basis, and there's nothing even close. Hedge funds can't compete with that return. Private equity hasn't been able to demonstrate that. And so in the alts marketplace, it's relatively new. Remember, private credit has really come to the forefront since the GFC since the banks started backing away, since 08, 09. So you only have 15 years of history of this building up, where hedge funds have been around a lot longer, where private equity's been around a lot longer. But the way we're managing money in private credit, phenomenal risk reward, and in this rate environment, higher for longer, it's a great time to lean in.
So staying a little bit on the risk-reward approach, with geopolitical tensions, tariffs, and supply chain disruptions, how do you think about constructing a resilient investment approach?
So geopolitical is very important to pay attention to. You know, Marathon has benefited in the public credit markets. We have high yield and we have broadly syndicated loan teams in US and Europe. We have an emerging market team that invests around the world. And of course, structured credit. But the emerging market team is focused on all these pockets of geopolitical risk, whether it's points in Asia, whether it's Ukraine and Russia, whether it's what's happening in the Middle East, whether it's points of tension in Latin America. It could be Venezuela, wherever it might be. But we're very, very tuned in that. And so it really does feed that information into our thought process. You know, tariffs shocked the whole world. And it shouldn't have been shocking at all. I know that in early November, when we knew who the new president would be, in early November of 2024, November 5th, that President Trump, when he was elected, and that his #1 objective was tariffs. And we knew that. And maybe I had some particularly good insight because I had dinner with Scott Bessent just a month before, and we talked about this in depth, right? So come April 2nd, what is known as Liberation Day, yes, he went a bit extreme in terms of the absolute numbers, but we knew the direction of travel. And we were preparing our portfolios and our mindsets for that level of risk and avoiding companies that would be particularly susceptible to tariffs. The big importers, some of the consumer companies that you know, would have to restock shelves, some of the consumer discretionary. And so it didn't come as a surprise, despite how much it shocked the markets. I slept like a baby in the months of April and May when the markets were just rocking. I was just so confident knowing that our book was adjusted and I had no tension at all. And so understanding the macro, understanding risks, and then doing your bottom-up work and doing credit selection is super duper important. And so what we try to do, given the geopolitical risk and the tariff risk and other macro factors, is really very, very specific to asset selection and who we'll lend to. So in fact, you know, leaning into asset-based lending and say aviation finance, you know, is pretty much insulated from what's happening in tariffs, or lending to a company that's non-cyclical, that's you know, consumer discretionary, that doesn't have a big imprint in import or export, you know, is a super safe place to lend, especially when you're lending at 4 times debt to EBITDA. And so I think having a strong top-down and understanding how it might impact your positions is important, while doing your bottom-up work in how you source, how you structure, the type of risks you're taking. So it's a tricky terrain that we're dealing with, but I think we've done a really good job navigating all this uncertainty and executing in terms of how we deliver in our portfolio construction. And it shows up in our returns, and it shows up in our loss rates, being some of the lowest loss rates that you can see in the industry across the board in everything we do.
And Bruce, what do you think, you know, the risk that investors are underestimating in their portfolios right now?
Well, there's a long list of that, and so that we could spend the whole session talking about. But let me drop one really key critical sector, which is one of the biggest sectors in the marketplace that private credit and the private equity markets have some of the biggest exposure to, that's greatly underappreciated, that's going to represent, I think, the biggest risk factor in the next 5 years. AI. AI is the most transformative technology since the advent of the internet. It will create more wealth in this next generation, these next decade or so, than any sector has ever created to date. It's going to be enormous in terms of its impact. There's creative destruction, and creative destruction will allow the software companies to convert to AI-first software companies. Google's doing that, Microsoft's doing that, Adobe's doing that, Salesforce, Snowflake, the list goes on and on and on in the public markets. Companies that have crossed the Rubicon already and will be AI-first software companies that are going to be driving the economy and growth and value creation. And then, you can see this in the public markets, but you can particularly see this in the private markets. There's 5,000 software companies, 5,000, that's the number, that are owned by private equity. And a great deal of those companies have been, and all these companies have been, this whole industry sector has been a phenomenal opportunity over this last generation. ARR, really strong margins, has allowed private credit lenders to fund the private equity sponsors at really high multiples because the margins are good and the annual recurring revenue has given you certainty of cash flow to be able to support that debt. That all changes. There's going to be the blockbuster video moment that's going to come where it's not creative destruction, it's just destruction. For a bigger cohort of the companies. The vast majority of the companies will make it through. The vast majority of companies will have an AI solution and their private equity sponsor will help them become a greater company down the road than they are today. And so when you look through a private equity book of software companies, they have all the upside. They may have made a 3 multiple and maybe they'll make a 4 turns multiple because AI will be that powerful an impact for them. But they're going to have more zeros in their book, more software companies that fail because the company wasn't able to make that AI adjustment. There's an old saying by Mark Andreessen, that famous venture capitalist from A16Z, that software will eat the world, meaning software is such an important part of the economy, an important part of the value creation, wealth creation. AI will eat software. And only that software companies that adapt and have creative destruction for AI will be the ones that survive at the other end. So as a lender, we only get par. We don't have the upside. We don't have that 3 multiple that turns into a 4 multiple. So what you have to do is manage the 0 defaults, 0 losses. And you can't afford the 0 recoveries. 0 recoveries. And if you have a 0 on a software company, chances are you're going to have a very low recovery rate. And I think the default rate for software, which has been 1/3 of that of the overall private credit lending markets, will become 3 times the loss rate compared to the other industry subsectors in the next 5 to 7 years. And I can't sit here, and neither can any lender, sit here today, make a loan, and know 5 to 7 years from now, when that loan comes due, whether that software company made the conversion from being a software company to being an AI-first software company. And so AI will eat software, and when it does, you have to come out on the other side as a company, as an AI-first software company, or your blockbuster video. And the recovery rate will be close to 0. Private credit is sitting on 20 to 30% of their book overall in software companies. Big statement, it's harsh. It's true, it's real. That's the #1 risk factor I'm focused on. So I'm calling a big timeout for the marathon team until I see and have a much greater understanding where companies lie within this understanding and development of AI, and until then, we're just not lending to software. How's that as the #1 risk factor? And #2 risk factor are some of the consumer discretionary sectors like retail and apparel that we're avoiding.
So Bruce, let's focus for a moment and actually 10 minutes approximately on private credit. Going back over the last 15 years or so, much of the interest in private credit has been the so-called premium earned over public markets through complexity and liquidity. As these markets converge, should allocators expect these premiums to collapse and collapse to a level where it makes less sense to allocate such large portions of a total portfolio to private credit?
It's a big question, and it's a really important question, Lionel. Thank you for asking that. Private credit, there's 3 legs to the stool. And you can do anything you want to do under the sun in private credit. Everything fits into the 3 legs. Direct lending, asset-based lending, opportunistic credit. And so, yes, there's liquidity premium, I agree, and yes, there's a complexity premium. There's also other types of premiums. You know, alpha is generated in the private credit markets, and it's generated by managers that can, because the average loss rate is about 1% today for private credit, and if you can lend and have a 0 loss rate, that's 100 basis points of alpha right there alone. And then you can apply leverage to that and create even a bigger return. So there's lots of, and then you have your unique sourcing channels where all alpha is also generated. So there's a lot of alpha that can be generated in private credit. Indirect lending, and so I'll just stick with that and answer the question for the sake of time that we have. So in direct lending, look, there's all kinds of direct lending. There's sponsor, non-sponsor, there's lower middle market, upper middle market. There's doing your senior loan at 4 turns of leverage, putting an extra turn of leverage and calling it a stretch loan, putting in the mezz tranche with it, or doing the mezz separately. And if you put the mezz tranche in it, you call it a unitranche, and all kinds of private credit lending models that people have out there. Where you really see the convergence, because that's really the essence of your question, with the public markets, is you have the broadly syndicated loan market. And if you have EBITDA above 100 million, which at 6 turns of leverage is $600 million of debt that it could support on a 6 times debt to EBITDA ratio, that company now can dual track with the broadly syndicated loan market. And when you can dual track with the broadly syndicated loan market, then the company and the sponsor is going to say immediately, hey, in the broadly syndicated loan market, I don't need to go to you, private credit lender. I can go to the broadly syndicated loan market, and I don't have any covenants, so I don't want any covenants. And the broadly syndicated loan market said, well, can you give me that little covenant that's out of the money so I can say I have some covenants? So you're taking on, a very different risk reward being covenant light on those loans. And also you have to compete in spread. And you can only price that loan 50, 75 basis points behind where the broadly syndicated loan market is, or the lender, the company would say to the lender, hey, I'd rather go to broadly syndicated loan market. So that's really where you see your competition. In the middle markets, where we tend to focus in terms of our lending, we see a much wider spread, much less competition, full covenants. We can do our debt to EBITDA ratio in terms of where we cut it at 4 to 4.5 times at a wider spread that today is, 5.25, maybe 5.50, not the 4 handle that you see that would be competing with the broadly syndicated loan market. So when I look at direct lending, yes, there's parts of the market that competes with the public market, and there are parts of the market that actually don't, and that's your middle markets or your lower middle markets. We prefer the middle markets because of the ability to put more capital to work and dealing with a more sizable company and the type of sponsor we deal with there. So that's our preference when doing direct lending. And then you go to asset-based lending, and I'd say, there's not the type of competition that you'd see in the direct lending business when we're dealing with, like we have a transportation team, for instance. And in that transportation team, there's 3 subsets. There's an aviation team, there's a maritime team, they're different people, different teams. And there's an on-ground logistics. Obviously, transportation for aviation does everything from Airbus 320s and Boeing 737s and commercial airlines to the engines themselves, and two, maritime, which can be anything from tankers and bulkers, to containers, Jones Act ships. It's a whole range of type of maritime assets that we're lending to, that we're leasing on. And then you have on-ground logistics, which is everything from chassis to trucks, to rail car. And so there's all these subsectors, and that's just one asset class of transportation. There's all these subsectors within asset-based lending that are quite unique and very unique channels that, yes, has complexity, yes, has liquidity premiums, but also has relationships and, flow arrangements and, relationships and ability to close. And that all, helps drives consistent returns and absolute returns.
And my last question before we wrap it up with the rapid fire questions, Bruce. I know you like it and you're excellent at that. There's been plenty of press about private credit's ability to generate alpha for investors. What is the private credit universe to Marathon, and what should LPs look for in their private credit manager to generate alpha?
Thank you for that. One of the key, first a little bit about Marathon. So we're in the public markets and we're in the private markets. In the public markets, we have investment teams for high yield and leveraged loans, emerging market debt from sovereign to corporates in the emerging markets, and the big corporates that are in the emerging markets. And then, of course, in the structured credit market, they have ABS and RMBS and CMBS and CLOs. And the private credit, which we already defined. But it's so informative. So if you look at high yield loans and high yield bonds, we cover about 3,000 names, 3,000 different companies in US and Europe. And that's so informative in terms of the underwriting that we do and the synergies it creates in direct lending. In opportunistic credit, doing capital solutions, or the feeder for the distress and dislocation that we see in the private credit markets and opportunistic may come from high yield loan or the brothers syndicated loan markets. So it's so informative, and the information flows, and the teams work together on the best outcomes. And then when we cover sponsors, we can cover the sponsor and do their direct loan. We can look in their portfolio and do their capital solution for a company that needs some bridge capital, or we can do the asset-based loan for that company. And so there's a lot of synergies that a global credit manager can bring both to our clients, bring their solution for public and private credit, public and private credit, and as well as the companies that we deal with themselves. And so the synergy and kind of the magic to Marathon, the way we've been performing, the way we've been executing is pretty magnificent. Now, the biggest managers in the world raise these enormous funds. And so the first question that LPs ask is, can they put the money to work, and will they widen the credit box or take more risk to put that money to work? As opposed to managers that understand how much money can be put to work, raise the appropriate size fund, not take excess leverage, take the appropriate amount of leverage, not widen the credit box, and be able to source high quality transactions with very low loss rates and therefore higher rates of return. So for me, it's all about absolute return, low level of volatility. It's about doing what you say you're going to do, make sure you can pace, put the money to work, make sure, on the credit side, we have the great benefit of getting a coupon and having a maturity that's a fixed maturity. And so we don't have to have the big, extensions that the private equity, continuation funds that private equity has to do, or do a NAV loan like private equity has to do to return capital. Returning capital and running a DPI that is consistent, where you can show your LPs a model of not only how you're going to deploy on a quarterly basis because you know your flow, and that, of course, there's some variability of that, but you have some level of certainty, and how you're going to return the capital. That's the key for us, is transparency and ability to execute.
Perfect. Thank you, Bruce. We have 1 minute for a few rapid-fire questions. Number one, 2 is or not 2 is?
Fed will not ease in the next 5 months.
Number 2, deficit for 2025 above or below 7%.
Default rate will be below 7% this year and slightly above 7% next year because the big, beautiful bill, the growth comes later, the deficits come shorter. So deficits will rise above 7%.
Okay. Recession or growth?
No recession, we talked about that.
Exactly.
In the next 12 months.
12 months, no recession. Private equity or private credit?
Private credit all day long. We have a 12% return across the board in private credit with a 4 to 5 vol. And private equity, having to do continuation funds, lower rate of returns. And we're making outsized returns because they're paying us big, huge coupons based upon a high base rate.
Biggest secular shift underway, you mentioned it partially.
Yes.
So
AI
disruptive, confirmed. Yes. Default rates up or down?
Default rates in the short run down, and the default rates will stay lower until we see a recession, and there's no recession call in the near term. So default rates will start to trend lower because the Fed will start to ease later, allowing for more stimulus and pro-growth policies more stimulative.
S&P 500, higher or lower at your end?
S&P 500, higher at year end. People are still haters of the equity market, despite full multiples. I think the technicals are favorable for second half growth being a little bit slower, but stimulative, and they'll look through that slower growth.
Yeah, and last question, Bruce.
Yes.
What are you the most appreciative of?
Most appreciative of my loving family, health, and the amazing people that I have to work with at Marathon every single day. When you work with people that are more brilliant than you in every one of the industry sectors, and I get to learn at my age, my ripe young age, I get to learn at my age all that I get to learn every day, reading through investment committees, co-chairing with our CIO, Lou Hanover, the investment committee, working with the amazing team that we work with. That's an amazing opportunity every day that I wake up to come into the office to work with my colleagues. And so I'm grateful for everything in life, and but particularly grateful for those 3 things. Thank you, Lionel.
Thank you, Bruce. It was amazing 30
You're
minutes.
amazing.
Thank you, everybody. Thank you for joining us.